Hey everyone, welcome back to Finance Flicks Hub. Today we're tackling 3 massive questions that have been buzzing through every trading chat room, Discord group, and Twitter feed all week. 1. Did Tesla finally break out of that long, painful sideways pattern we've been watching for months? 2. With Bitcoin and crypto pumping, are we looking at the start of the next big bull leg, or just another head fake? 3. Is the S&P 500 ETF, that's the SPY, about to cancel its recent bearish setup, or is this just the market teasing us before another pullback? And as always, I'll break it all down for you in plain American English, no confusing Wall Street jargon without an explanation, no $10 words unless they earn their keep. But here's the thing, this isn't just a news report. By the time a story hits the headlines, it's usually too late to act on it. What I'm going to give you today is a full map of the territory. I'll also walk you through a couple of trades we've been tracking, one of them already delivered a double-digit gain in under a week, plus my bonus stock for August that I think could be gearing up for a monster run if it clears a key price level. So grab your coffee, keep the trading journal handy, and let's get into it. Let's start with Tesla. If you follow Tesla's chart, and let's be honest, even people who don't trade Tesla watch Tesla, you've probably heard folks saying it's finally broken out. Here's the reality, not so fast. Tesla's been locked in what's called a pennant pattern for months. Imagine you're watching a football game and both teams are pushing toward midfield, neither side can break through, but the action keeps getting tighter and tighter. That's a pennant, high lows squeezing up into lower highs, until eventually, one side has to win. This week, Tesla touched the top trend line of that pennant, but here's the key, it didn't close above it. It just tapped it and pulled back. In technical analysis, a breakout isn't just touching the ceiling, it's closing above it and proving it can stay there. The textbook confirmation is, and Tesla has a history of fakeouts. Back in January, we saw the same thing, a breakout that looked real for about 48 hours before the stock rolled over and punished late buyers. So what's the play here? If you're aggressive, you can scale in once it closes above $336, but if you're conservative, you wait for that second candle to confirm. Either way, your stop loss has to be tight. Tesla moves fast in both directions, it's like a sports car with a hair trigger accelerator. Now let's talk about Bitcoin and the crypto crowd. Yes, prices have been pumping. Bitcoin popped hard after yesterday's session, and altcoins followed like they just got a group text from the same hype machine. But here's where experience matters. Big green candles are exciting, but without confirmation above key resistance, they can fade faster than a TikTok trend. For Bitcoin right now, that line in the sand is what I call the 120 level. Now, I'm not talking about $120, this is tied to a specific index value we use to gauge momentum. Once Bitcoin clears that, we've got room for a serious leg higher. But until then, this pump could still be part of a bigger consolidation. This is where crypto traders get trapped, they buy on emotion during the spike, then get shaken out when the next 8% dip hits. Patience isn't just a virtue in crypto, it's a survival skill. Remember December 2017? Bitcoin screamed past $15,000 on pure momentum, only to slide back down to $11,000 within a week. That's why I always say, have your trade plan before you hit the buy button, not after you're already in the trade. Now, the SPY, basically the S&P 500 in ETF form, is having its own tug of war. Last week, we had a bearish engulfing weekly candle. For newer traders, that means the entire range of the previous week got swallowed up by a bigger down candle. That's often a warning shot from the bears. This week, the SPY bounced right back, printing a bullish candle, but here's the catch, it's still under that critical 637.48 level. For the bulls to officially cancel that bearish setup, we need, one of the best lessons I've learned over 15 years in markets, price levels are like doorways. If a stock can't get through the doorway cleanly, it's not ready to enter the next room, no matter how good the party sounds on the other side. We've got 2 stocks from our recent watch list that deserve an update, AMX and USR. AMX, we bought the dip last Friday. That trade already gave us a 100% gain on the options earlier this week and another 56% this week. That's textbook dip buying in a strong trend. But here's the thing, AMX is now sitting at resistance between $8.80 and $9.90. I've taken profits here because resistance is where risk starts to tilt against you. If it pulls back toward $8, I'll happily reload, but only if my stop at $7.92 stays safe. If support holds, we could see $10 in the near term. USR, our rare earth play. We call this one as a buy under $13, ideally closer to $11.50. It ran right into our target zone between $17 and $20. Could it go higher? Sure. But this is a profit-taking zone, and the pros know it. Rare earths are vital for tech, EVs, and even defense, but even the best sector story doesn't mean you hold forever. You get in, you get paid, you get out, that's how you protect your capital. Now for my bonus stock pick for August, Bull, ticker symbol Bull. Key level here is $17.10, that's the IPO high before it sold off. In IPO psychology, the first time a stock reclaims its IPO high, it can trigger what's called price discovery, basically, no more overhead resistance from bag holders. If Bull closes above $17.10, I see a target of $24. And if it clears $24, we could be looking at $36.60 longer term. Right now, it's consolidating around $15, which is like the calm before a potential storm. We've got big green volume spikes, that's institutions quietly loading before they make their move. Everything we've talked about today boils down to one thing: have a plan before you take the trade. That means, if you don't have those three numbers, you're not trading, you're gambling. This is why I'm so disciplined about levels. Take RTTD and Eli Lilly examples from earlier this year. The difference between making 40% and losing 20% was simply knowing when to step off the ride. So, here's what I'm watching this week: trade smart, trade with a plan, and remember, the market doesn't pay you for how much you trade, it pays you for how well you trade. I'm here to help you be on the right side of that equation.